Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tuhu Car Inc. Annual Report. Tuhu Car Inc. offers a wide range of automotive services and products through its online and offline platforms. The company's business scope includes the sale of tires and chassis parts, as well as auto maintenance services such as fluid chemicals, storage batteries, and maintenance accessories. In addition to these services, Tuhu Car Inc. also provides auto repair, car detailing, and automated car wash machines and products. The company offers various automotive products through its online interfaces, including the Tuhu Automotive Service app, website, and Weixin mini program, as well as offline stores. Tuhu Car Inc.'s business extends beyond automotive services to include advertising, franchise, and other services such as insurance brokerage and agency services, software-as-a-service solutions, new energy vehicle sales, used car transactions, and used car transaction services. Tuhu Car Inc. maintains a market capitalization of $11 billion, broadly in line with the industry peer group. Tuhu Car Inc. trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 1.91 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, the accelerated consolidation in the supply side of the market has led to a competitive advantage through an integrated online-offline service model. Additionally, technology iteration has provided new tools and possibilities for automotive service industry transformation. The company's diversified product capabilities and proactive pricing strategies have also contributed to revenue growth. Furthermore, user growth, with 23.5 million registered users YoY, and omnichannel transacting users growing by 17.7% YoY to 28.4 million, have been significant drivers of revenue growth. Other key factors include increased penetration rate among China's passenger car owners, improved user repeat purchase rate, strong brand image, and excellent user reputation. The company has also implemented various incentives for offline stores and technicians, which has led to a 6% YoY same-store user growth in Tuhu workshops. In terms of specific product categories, the auto maintenance segment saw an 18.2% YoY growth, while motor oil sales grew by over 40% in the low-price segment and 45% YoY in private label products. Quick repair also experienced over 50% YoY growth, driven by standardization of product SKUs and service requirements. The company's expansion into new electric vehicle (NEV) services has been a significant driver of revenue growth, with an increase in NEV transacting users by 60% YoY. The penetration rate of NEVs on the platform is also higher compared to China's ownership rate. In terms of operational efficiency, the company has implemented various initiatives such as intelligent stocking algorithms, improved inventory turnover days, and increased regional fulfillment rates. Additionally, AI-powered customer service and warehouse automation have contributed to revenue growth. Overall, the company's diversified product offerings, proactive pricing strategies, and technology iteration have been key drivers of revenue growth. The net income of the company decreased over a certain period. This decline in net income can be attributed to various factors affecting profit margins. The gross profit margin, which represents the difference between revenue and cost of goods sold as a percentage of revenue, also saw a decrease from 25.4% to 24.1%. Furthermore, operating expenses increased by 18.1%, with specific categories such as operations and support expenses rising by 26.6% and research and development expenses increasing by 19.4%. The decline in gross profit margin and the rise in operating expenses contributed significantly to the decrease in net income. Additionally, other income and gains net decreased by 29.7%. These factors collectively led to a reduction in profit margins, ultimately resulting in a decrease in net income. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various expenses. According to the financial statements, as confirmed by pages 32, 33, and 40, the company has consistently demonstrated a surplus in operating cash flow. This is a crucial metric for any business, as it indicates the ability of the company to meet its short-term obligations and invest in future growth initiatives. The generation of positive operating cash flow also suggests that the company's management team is effectively optimizing its operations and making smart financial decisions. This, in turn, has contributed to the overall improvement in the company's financial health and stability. The company's debt level has undergone some fluctuations over the years. Initially, interest-bearing borrowings decreased significantly from RMB 75.7 to RMB 202, indicating a substantial reduction in debt. However, this trend was short-lived, as the debt level increased again to RMB 75.7 on another page. Meanwhile, non-current liabilities showed a moderate increase of 2.1% over 2 years. Regarding interest expenses, there is a notable lack of information provided in most pages, making it difficult to assess any significant changes. The absence of data on interest expenses suggests that the company may not have experienced substantial fluctuations in this area. Overall, while the debt level has seen some variations, there is no clear indication of a significant change in either debt level or interest expenses. Management's outlook for the company is one of growth and expansion. They plan to strengthen their presence in lower-tier cities and improve regional balance by expanding into new markets. To achieve this, they will focus on core subcategories in quick repair services and leverage new technologies such as AI, warehouse automation, and autonomous delivery to improve efficiency and user experience. The company is also investing heavily in technical capabilities to support business growth, including the expansion of their franchised workshop network and ongoing platform investments. This includes a commitment to continued investment in technical capabilities, which will enable them to refine and optimize marketing strategies, diversify product offerings, and expand their services. In terms of revenue growth, management expects it to come from the automotive products and services segment, driven by the expansion of their Tuhu workshop network and ongoing platform investments. They also plan to increase treasury investments by 3.6% to support operational requirements and strategic initiatives. Overall, the company's strategy is centered around leveraging new technologies to drive growth, expanding into new markets, and investing in technical capabilities to support business development. This includes a potential dual listing on a recognized stock exchange, which would provide additional funding opportunities for future growth. That concludes the financial summary for Tuhu Car Inc. Feel free to comment below, and I will be happy to answer them when possible.